Federal holds rates steady, leaves September hike on table. Washington. The Federal Reserve, which kept its key interest rate unchanged Wednesday, provided an upbeat view of the labor market and economy, leaving the door open to a September hike. In a statement after the two-day meeting, the Federal said risks to its outlook have waned, but it gave no clear signal about its upcoming plans. Weak employment reports in July and August almost certainly would stay the Fed's hand when it meets again in September. Near-term risks to the economic outlook diminished, the statement said, among its most positive appraisals in months. And while policymakers reiterated that they continue to monitor global economic and financial developments, there was no mention of the uncertainty or risks generated by the United Kingdom's vote in late June to leave the European Union. Global stocks sold off after the UK referendum, and while they have more than recovered their losses, economists said further turbulence may lie ahead. The Fed's statement puts a September rate hike back in play, says Scott Anderson, chief economist of Bank of the West. But he added the Federal would need to see further upside surprises on U.S. jobs and economic growth, an improved global outlook, and more signs that inflation expectations are starting to normalize. Markets say there's just an 18% chance of a September rate increase. The Federal also painted a generally positive portrait of the U.S. economy. The labor market strengthened and economic activity has been expanding at a moderate rate since the Fed's mid-June meeting, it said. It added that job gains were strong in June following weak growth in May, and household spending has been growing strongly. Economic growth in the second quarter is expected to approach the healthy 3% annual rate after feeble gains the previous two quarters. At the same time, the statement noted that business investment has been soft, a byproduct of a listless global economy, strong dollar and the oil industry downturn. It also reiterated that inflation remains below the Fed's 2% annual target. Federal officials have said in recent weeks that persistently low inflation means there's little urgency to increase rates. The Federal has kept its benchmark rate unchanged since raising it in December to a still meager 0.4% for the first time in 9 years. It has cited a sluggish global and U.S. economy and financial market turmoil. Employers added just 11,000 jobs in May, helping prompt federal officials to stand pat at the June meeting. Federal Chair Janet Yellen said then that policymakers needed assurances that the economy and labor market were back on track before lifting interest rates again. Employers added a blockbuster 287,000 jobs in June, but that's likely not enough yet to convince wary federal officials that the labor market has regained its momentum. Barclays economist Michael Gapen predicts that solid payroll gains in July and August would prod the central bank to make a move in September. Yellen last month also said the Federal was wary of the UK's then looming Brexit vote on whether to leave the European Union. The vote to succeed a week later initially caused markets to plummet before they staged a rally that pushed stocks to record levels. Yet lingering uncertainty about economic ties between Britain and Europe could further roil global markets. Federal policymakers also are hesitant to lift rates too quickly when several other central banks have pushed rates further into negative territory. Relatively high U.S. rates strengthen the dollar, hobbling U.S. exports and the economy. Policymakers' median forecast in June indicated they expect just 2/4 percentage point rate hikes in 2016, down from their December projection of 4 such increases.